Welcome to the Gray Report. I'm your host, Spencer Gray. Every single week on the Gray Report, we're breaking down the latest information, news, articles, and research related to the multifamily industry, commercial real estate, and the economy to try to arm you with the best information and intel to help you make some really good decisions. So whether you're an active investor, you're passive, maybe you're somebody that's working in the multifamily industry, property management, capital markets, it doesn't matter. You're in the right spot. We're excited to get into it. We've got some major topics to discuss today. First off, the Trump administration is coming out and they are saying no more institutional buyers of single-family homes. You buy 1,000 single-family homes, you're out of the business. You can't do it anymore. But it's like we've got Elizabeth Warren and Bernie Sanders running our housing policy, understand. All of a sudden, it's crazy to think about intervening in private markets the way they're suggesting. But in addition to that, another announcement was that the FHA, the Federal Housing Administration, is being told by the Trump administration to buy $200 billion of mortgage-backed securities, MBS, with the idea we're going to make housing more affordable. But is it actually going to make housing more affordable, and for who? And regardless, how does this impact the multifamily market? I'm just going to give you a quick teaser. It's actually a benefit to the multifamily market, even though it might not be the right thing to do. Then lastly, we've got the December report from Yardi Matrix going over the really weak year the multifamily had in 2025. Specifically, we've basically had the fourth quarter wipe out any and all of the gains that we had seen in the multifamily market in 2025. But is 2026 going to be just as slow, or are we going to see a reversal of that trend and see a return to sustained growth? Well, you're going to have to watch the whole episode to get all of those details. Stick around, like the video, subscribe to the Gray Capital YouTube channel for more of this content. I'm joined by Griffin Haddad, once again, co-host of the Gray Report. This is going to be an awesome episode. Let's get into it. All right, everyone, welcome back to the Gray Report. I appreciate you taking the time to watch or listen to this episode wherever you are listening and watching from. Griffin's joining me once again. Griffin, great episode put together. The newsletter is absolutely crushing it. Folks, if they're not signed up to the Gray Report newsletter, graycapitalllc.com/newsletter. This is a collection of some of the best pieces. How's your week been? How are you feeling? And how do you feel the market's been since the last time we spoke?
Right. Week has been good. Weekend was enjoyable.
That's good.
Watched some Hoosiers football with some friends this past weekend. Got an exciting Monday coming up. The markets.
Hold on. Got to stop you there. Indiana football being so dominant. How related is it to Indiana multifamily being dominant? I mean, Midwest multifamily dominance. Indiana is dominating. Indy is just on the top of the list of so many multifamily investors. I just don't believe in coincidences, Griffin.
No, some people would say
Connect
it's
the dots.
uncorrelated. I think we could probably put some evidence together.
I think there's a lot of momentum
draw
just
a nice
pushing
correlation
Indiana.
between those two. Whether it's folks wanting to be closer to their kids in school, renting apartments, they can come visit for long periods of time, or maybe this football coach really does just win.
Well, I think he might, but also it's just another example of folks writing off Indiana, variety of ways, and being surprised, and where we're not surprised. We didn't see Cignetti coming the way that he has been, and this year has certainly been a surprise
with past history of sports, being in the building, in the huddle, in the locker room, team meetings. All that matters
you've seen this firsthand.
Is the belief that you have in that building. All the noise outside doesn't really matter. You can take it to heart, you can make jokes about it, but really it's the buy-in from the people that you've got, kind of inside of your structure, inside of your building. How does that relate to multifamily of the Indiana continued performance and or the Gray Capital team in the midst of outside headwinds, people, being naysayers, critical, you got to control the controllables inside of your personnel to ensure that everybody does theirs. Fernando Mendoza, Heisman Mendoza would say everybody just did their 1/11th.
Yeah.
which is there's 11 guys on a football field,
Yeah.
so everybody
Their
does their
part.
1/11th. If everybody does their job, the execution should be high across the board. So,
Yeah.
and in multifamily, specifically property management, I think you could apply kind of that same mantra, that same kind of blanket of teamwork
Yeah.
mentality of, look, if the maintenance department doesn't show up at a full level, for days on end or a single day, then everybody kind of takes a reduction of performance. If we don't sign leases, then a reduction of performance. So everybody needs to be, fully motivated to get up and do their best work and fulfill their 1/11th.
Yeah, I think teams are teams. How people are motivated and how you push yourself and those around you to do more and take that next step, and pursue a common cause. But so much of it comes down to the belief that it's even possible. I don't think that the IU team would be half of where they were if they didn't think that it was possible. And so at some point they got it banged into their head enough times to where they believe we can actually be national champions, which is a crazy thing to go from, like, we've never done this before, it's never been done in our school's history, what does it even look like, but to be convinced that it is possible. And I found myself, from when we started building the team here at Gray Capital, I started investing in apartments, as a GP back in like 2015, 2016, but I really started building the team end of 2019 into 2020 when we started doing our own lead sponsor deals, brought Jay on the team, just started expanding. And I've told the story in a couple different ways, but COVID happened, and everything was shutting down, and we weren't sure if there was going to be any commercial real estate, if anybody was going to be paying rent. And so whether it was that instance or if it was, fast forward to when interest rates were being jacked up in 2022, to any of the economic, social, geopolitical bumps in the road, or the uncertainty of where's the market going to go. I felt it's been my responsibility to get in front of it, get in front of everybody, and saying, no, we're moving forward. This is the direction we're going to move. Not only is it not all lost, but we're still moving forward, to that next mountaintop, to the promised land. This is the direction we're going to go. It's possible. We're gonna do it. The sun's gonna rise tomorrow. Let's just keep moving forward, because it's easy, with property management. There's so many fires to be put out. It's easy to get bogged down into the weeds, whether that's focusing on kind of the personnel issues with hiring, bringing on the right teams and all of the different individuals that it takes, that 1/11th to get the job done.
Yeah.
To again, just macroeconomic forces that are absolutely outside of our control, so we can't really worry about, but we need to be aware so we can pivot and move in the right direction and reposition ourselves.
Right.
So
takes a lot of buy-in from the other 10 members per se.
Yeah.
To go and achieve those short-term goals in order to get to the long-term goals. So
Yeah.
A clear path and with the believability so that people can buy in is largely important. I think that's what you're seeing at IU down there in Bloomington this year. It's
100%.
fun to watch.
It is fun to watch. All right. Well, okay, we've got a new section we're going to do on the Gray Report. This has never been done before. First time if you're listening. You're one of the first people ever to listen to this. So it's a new piece, and we're going to work on the name. But right now, it's the multifamily jargon bin. We're taking terms, multifamily terms, and phrases that you may know, you may not be familiar with, and we're breaking them down. Our audience on the Gray Report tends to be more sophisticated. We kind of put them in the kind of the intermediate to advanced. We don't have a lot of first time investors, but we do have some, and we do want to be able to provide content that resonates with the very advanced investors as well as I'm just exploring this for the first time. So breaking these terms down that to us in the industry we use as shorthand day in and day out. But what we've got folks I know in our office still that probably aren't fully familiar with some of these terms, what these terms mean. And so we want to break them down in 3 different ways. One, as simple as possible, 5th grade understanding. Second, relatively novice investor. I know about investing, but just kind of in the simplest terms. that has a little bit more context. And then kind of in the third method of, true, nuanced, experienced investor, how do we at Gray Capital think about this term, and just going a little bit deep. So the first term, it's the one that everybody talks about, and it also has, I think, the most questions, and it's probably the term that most people, there's a lot of people who don't know what the term means, or they kind of do, and they're just like, yeah, and that's, they just kind of nod their head and like, I kind of know what it means, and that is cap rate, the capitalization rate. We talk about it all the time. We hear people say, is that a good cap rate, or what's a good cap rate, or where are the cap rates? And all of those questions can be difficult to answer because, a cap rate can mean different things to different people. So let's break it down. Any questions about cap rate, Griffin?
No, I'm excited to talk about it. Excited.
So from the easiest definition that I could come up with is a cap rate is a simple way to understand, right? How much money a building makes compared to how much it costs. So how much cash flow does a building put off or to distribute relative to what it costs? So if you have a $1 million building and it's making $50,000 worth of cash a year, that's a 5% cap rate. If it was making $100,000 a year and it costs you $1 million to buy that building, that would be a 10% cap rate. So you can see the higher the cap rate goes means there's more kind of cash flow that's being put, that property is distributing, is putting off. So if you think about it as if I buy this building, how much money does it earn each year for every dollar I paid? Okay. So now going to a little bit more nuanced, a little bit more advanced, it's, so the way we calculate cap rate is we take our net operating income divided by the value of the property that provides us our cap rate. Okay. So we also know that if we take our, the value of the property times the cap rate, we're going to be able to determine what our net operating income is. So we can use it a variety of different ways. Whether we only need to know 2 out of 3 variables to be able to determine what that third variable is. So by knowing a little bit about a property, again, if I know how much net operating income or NOI it's producing, and if I know kind of the cap rate that properties are trading for in the area, I can estimate the value, the market value of that property.
Right.
The challenge is, what is a good cap rate? There is no going cap rate in a market. It's relative to what the market believes the risk is for that asset, for the asset class, and that given property itself. The lower the cap rate is, so a lower cap rate means that the price is actually more expensive. So a property that has a low cap rate will have a higher price than that same property. If it had a higher cap rate, that means that price is going to be lower because the price that you have to pay relative to that income. So again, let's look at that, the $100,000 income off the $1 million property. If I'm willing to pay $2 million for that property, all of a sudden that goes to, instead of a 10% cap rate, for the $1 million property, $100,000 distribution, if I paid $2 million for it, it would be a 5% cap rate. So if I'm in a bidding war, you and I are trying to buy this property. You want to pay $1 million. I want to pay $2 million. Obviously, I'm paying up. I'm paying the higher price. I'm buying it at that lower cap rate. So lower cap rate, higher price. Higher cap rate, lower price. So then the next level of how, I think more, call it sophisticated investors, is that cap rate comprises a lot of information. It tells you about risk. It tells you about the type of market. It can tell you about liquidity. It can also tell you about future earnings. So a cap rate may be low, for example, on a value add deal, which means it's expensive relative to the cash flow that it produces. The reason that might be expensive and the cap rate may be lower, even though individuals might say, hey, that's an older building. Like, what do you mean it's going to go for a lower cap rate? But if it's in a market that has a big opportunity to increase the rents, an investor might come in and speculate, well, I can increase rents at this property $200 to $300. And so my in-place cap rate, which might be relatively low, in-place cap rate is the actual cash that the property is producing today. That might be low. But my stabilized cap rate, which is the cap rate after I've bought the property, after I've raised the rents, and I've stabilized the revenue and the net operating income, that stabilized cap rate may be much higher because I've purchased the property, but I've increased the income and the cash flow from the asset itself. So that cap rate has moved from call that low 5%. Now I'm operating at an in-place cap rate of 6-7%. People confuse cap rate with return. Cap rate is not really your rate of return. You can think about it as an unlevered return, and it's a proxy for that. But the reality is no one just pays $1 million for the property. If the purchase price is $1 million, that's not all the money you have to pay. You typically have to bring money to the table for some renovations. You have fees that you have to pay. You have financing costs. And so, you think you're bringing $1 million. It's actually, maybe it's 1.2, 1.3. And so, yield on cost, which is the total cost of the total capitalization cost, all of the dollars that go in to that property, you divide that by your actual income that's distributed. And that's your true yield on cost, the yield of what it costs me to actually buy it, which is different from the cap rate, which is derived from your purchase price or your value. The reason why we do that, though, is to keep things relative, and you can compare property to property, market to market.
Right. Taking the LP lens, I want to meet you somewhere in the middle, at our middle level of sophistication and understanding of a cap rate. You're an LP thinking about making a private placement, really just across commercial real estate, but for today's purposes, Midwest multifamily asset class.
Yeah.
You see a cap rate come across the table from a sponsor that's offering you a deal. Let's say it's a 5% cap rate. As an LP, when you see that 5% cap rate, because the cap rate is a great tool to evaluate a deal rather quickly. There's other nuances and variables that should likely be considered. But if we're focused specifically on that 5% cap rate, what does that tell you about the project before you even turn the page to look at any of the other details?
Well, I'd first say I would never just look at a cap rate in isolation, and I would ask, okay, what 5% cap rate, is that stabilized? Is that in place? Because in place 5% cap rate, that seems relatively low, but it could make sense relative to the business plan. Because again, if that in place cap rate, that represents, if it's based on their trailing 12 months of financials, I'm evaluating, the income from the prior owner, which has a lot to do with the future cash flows. But if I have a business plan to do something different from the previous owner, I'm not going to make the decision to invest solely based upon that in-place cap rate. I want to know what the business plan is to get to, whatever stabilized cap rate or stabilized yield, and evaluate how feasible I think that business plan is to get to that point of stabilization. And so, but if I hear 5%, 5% cap rate, again, I'd have some questions on, is it based on, are we talking about an in-place cap rate? Is it based on T12, financials? So I know that I'm actually comparing cap rates of what I think a cap rate is to what you're telling me. Because what you'll hear a lot, whether that's through brokers or syndicators, they'll give you the stabilized cap rate. It's like, we're buying it. It's going to be a 7%. It's a 7% stabilized cap rate. It's like, well, that's great. But if you can't execute your business plan, you don't get 7% ever. You get the 5, the 4, whatever you actually bought the in-place cap rate at. Brokers and others will also, they'll play around with the time periods for the financials. So they'll say, this is the the trailing 3-month income, but but the trailing 12-month expenses.
Right.
So basically, it's like they had a really good 3 months. Forget the other 9 months of the year. We'll take their annual expenses, because expenses can be weird. There's weird seasonal behavior that goes on on the expense side. Same thing with revenue. But so they'll take basically like, hey, we have a great 3 months. We're going to value it on the last 3 months, which that takes a sophisticated investor to understand, that the last 3 months are indicative of the trajectory of the asset, of the property, or were they just, giving out concessions, crazy marketing spend in the last 3 months were an anomaly, and you're really paying a what seems to be attractive cap rate. They're saying that it's on the trailing 3 month income T12 expenses, it's a 5.5, it's a 6. But then you use that 12-month income cap rate, and all of a sudden it's a 5, or if it's a 4. And sometimes they do that because let's say the property had a problem 11 months ago. There was a car, drove off the road and crashed into something that had nothing to do with the property, really.
Right.
Oh, that was next to a road. And the property had spike in vacancy because of that, for whatever reason. People had to move out. And so we went down to 85%. Well, so you'd want to exclude that month because, right, that's not going to happen every year. Let's exclude that. Let's just use, an annualized period of the last 6 months or 3 months. Maybe that's appropriate. Or it was in lease up. Let's say the property was only 50% leased up 11 months ago, but it's been leased up for the last 6 months. Well, yeah, it probably makes sense to use the last 6 months versus the last year because you're not in lease up anymore. Right. So there is a lot of nuance, and it's okay to ask. Okay, what is that cap rate based on? What kind of cap rate are we talking about? Again, is it stabilized? Is it in place? If it's in place, we're talking 3 months, 1 month, 12 months. And so you can see how all these numbers can be manipulated. But by being knowledgeable about the differences in cap rates, different ways to look at them, you can at least arm yourself to ask the right questions.
Right. Makes a lot of sense. The cap rate conversation can get a little bit muddy because it can get very complex. Will be a good opportunity to maybe dive into this conversation maybe in the next podcast or weeks down the line of just, what truly influences a cap rate. And I know we use cap rates on acquisition, but we also project, cap rates at disposition. So be interested to kind of dive into what makes up some of those exit assumptions to calculate, an ideal exit cap, and then maybe how we're using or differentiating our entry cap from our exit cap, and how those calculations are getting made. There's an audience for that. I'm not sure that they're, specifically watching the Gray Report, but would be an interesting conversation.
Know. Everyone might just be sitting around and be like, let's talk about cap rates all day. No, we've talked about them too much. But but let us know in the comments if you want us to talk about more about cap rates. We can go into even more detail. Because, again, like Griffin, you were saying, there are so many tools you can use cap rates for. Like for evaluating, the ROI on, renovation or, the true value of expenses, because the cap rate is essentially a way to put a multiplier on the money that is going in or out of a property.
Right.
And so, again, like you can say, well, that expense, that's going to cost us, $20,000 of recurring revenue. Okay, well, maybe $20,000 doesn't seem like that much, but if you put a cap rate underneath it and all of a sudden it's, hundreds of thousands of dollars or, $1 million of value that's missing from NOI. When you go to sell it and someone puts a cap rate under your NOI, again, that's the value that they're going to extract. So again, $10,000 of more revenue or $10,000 of more or less expenses, that all, put a multiple on that. And so it really shows you how important, the kind of the nickels and dimes and how important every single lease is at a property when it comes to actually valuing it and selling it at the end of the day, which is also how we can force appreciation. Why multifamily and commercial real estate is great because the properties are valued based on cap rates, based upon income. So if we can add income or get NOI up by reducing expenses, there's almost a 20x multiplier that's tacked on to that savings. Or value or revenue increase. Yeah, it's exciting stuff.
The cap rate being a snapshot of a moment in time with, past historical financials and future growth kind of baked in. It does kind of get to be somewhat of a guessing game. And I would be interested in furthering the conversation of how does Gray Capital go about, figuring out which cap rate is palatable, which cap rate is simply not palatable. What factors of the cap rate conversation and the equation are we really taking into maybe larger impacts into our acquisitions? A lot to kind of contemplate, a lot to bake in. You can tweak the cap rate on exit and create some very serious value, very impactful value. But you can also kind of tweak the cap rate going in, just based off of how much you're willing to pay for a project. So it's an interesting conversation of this. ever movable, slider of where the cap rate may sit and how it can truly impact an investment moving forward.
Yeah, it is interesting. It's something that we use a lot, but with variable weight, I guess, that we put on it. I mean, we use it again as a tool to compare. Like we're looking at a project. Just the first couple of glances, and a question we might ask. What is the cap rate of it? What are they at? What are they asking? They're asking for $50 million. Okay, what is that? What cap rate is that?
Right.
And then they're like, well, it's a 5 cap. It's like, well, okay, well, what is that? It's cap rate on T12. What? And it's cap rate on T12. Okay, 5%. That seems low. It kind of seems where market is. But then you look at it, like, for example, a property that has a 5% cap rate but has no ability to grow rent versus a property at a 5% cap rate that's in a market or the opportunity to grow rent significantly, high rent growth. Well, those are two completely different prospects because, one, you're going to be stuck at a 5% yield or less for foreseeable future. The other, you're going to grow out of it. You're going to move to that stabilized number. And so again, it's the deal, it's the market, it's the operator, and it's the business plan that all have to come together for you to make a decision. But a cap rate can be a really good tool in a way for us all to communicate about kind of the cost relative to existing yield.
Right.
Yeah. So fun stuff. All right, let's jump right into this, Griffin. When this came out last week, I couldn't believe it. We've done a lot of reporting on, and actually last Gray Report episode, we talked about how there were going to be some major announcements by the Trump administration in regards to housing. This is not exactly what I thought that they were going to announce. We've been waiting for maybe, some regulatory reform, permitting reform, something that would actually, increase supply of housing and tackle affordability. Or we even talked about, yield curve control and getting the 10-year treasury down to make mortgages a little bit more affordable. That's not exactly the direction the Trump administration has chosen to go. They've really taken a note out of Elizabeth Warren, Bernie Sanders, Stalin and Lenin's playbook, and have decided to ban large investors from purchasing private property, large investors from purchasing single-family homes, basically saying that homes are for people, not corporations. I guess they have missed out that when corporations buy the homes, they turn them into rentals and people live in those rentals. Very troubling development because, again, any type of major government intervention, not telling people or companies what they can buy, what they can't buy, who should be buying these this type of group should be buying, this type of group can't be buying. There's just all of these unintended consequences, and I just don't think it's really good for the economy. But we wanted to break into some of the details to kind of quantify the situation, give some clarity, because there's so much misinformation regarding this topic. Griffin, what was your reaction when you saw this come across the wire?
It's a really interesting, I think, proposal, and I think we've seen this in maybe the first 4 years of this administration, and then maybe in the second. But there's a lot of proposal for action, but maybe not a whole lot of action maybe being taken on fronts like this, where it's like, hey, I want to solve the housing affordability crisis here, so I'm going to do it. The 50-year mortgage got mentioned earlier in the year. We just haven't seen anything really come to fruition on that just yet.
No.
Now, maybe things do take a little bit more time in the government proceedings. This one is kind of a head scratcher just after looking at a few of the numbers and stats regarding to, the overall single family home, availability on the market today versus how many people own a single family home versus how many of these homes are owned by institutional allocators. The percentages are quite low, and it seems like the number of homes owned by large institutional ownership groups are, minuscule compared to how many of these single family homes are owned by actual families that live in the homes. I was reading this article, and it was quite interesting. I was maybe a little bit too naive, young, inexperienced back in 2008 with the great financial crisis. But this article specifically mentioned how a lot of these large institutional groups actually stabilized the market by coming in and acquiring large quantities of single family homes. It was actually a positive benefit to the overall economy. And so I thought to myself, well, if you continue with this ban and we have something that maybe resembles 2008 or any kind of housing crisis again, the individual groups or the group of institutional allocators and investors that stepped in and stabilized the market are now unable to even do that.
Yeah.
And so
you're not allowing capitalism in the market to actually work.
Yeah, you're telling capitalism to essentially take a hike based on. I'd be interested in just kind of see the data that this administration was presented, because the data that I'm reading, it just doesn't seem like
it's not housing. They were looking at polling. They were looking at polling data.
Yeah.
They're not looking at housing data, because if they looked at the actual data, they wouldn't have decided to do this. This is just to hit the populist chord and to get in front of the midterms. So the reality is, just getting into some of the numbers, and there's a couple different sources, but so far, non-owner occupied homes, it's anywhere between 16 and 30% of the overall market. But for actual large institutional investors, it's 1 to 3% of the overall market itself. Like you said, these large investors didn't really exist prior to the great financial crisis. They came in and started buying up homes because there were no buyers for them. There were no buyers in the market. They're the only ones that could step in, and they essentially stabilized the market. They added that backstop to be able to prevent prices from falling even further and completely destroying the wealth of Americans. The reality is today, there's a lot more renters than there are homeowners. And that's for a variety of reasons: affordability, we could get into the Federal Reserve and inflation and wealth disparity, all of these reasons. The reality is renting is more affordable than buying a home, and renting is probably appropriate for a lot of people rather than buying a home. We've talked about a lot on this show. The single family home, the American dream of buying a home, it's a good concept in terms of a lot of Americans have built wealth through buying a home, but it's not the only path to building wealth. The path to building wealth is to add assets to your personal balance sheet, whether they are real estate assets, physical assets, or their equities. You have to add assets to your balance sheet. Mm-hmm. And it happens to be, for most Americans, home is their largest asset. And that's great for a lot of individuals. But the reality is, not everyone can buy a home. Not everyone has that down payment. Mm-hmm. And small tweaks like doing this, or, we're talking about buying more mortgage-backed securities, that's going to reduce interest rates slightly, a couple basis points here or there. That's not going to change. That's not going to be a game changer for the economy. It's going to be on the margins. So there's still going to be a lot of renters. And by banning single-family homes from becoming rentals, mm-hmm. which is probably where the demand is, you're forcing those properties to remain being owner-occupied, which removes rental stock, which increases rents overall. And it doesn't really move the price from the single-family home. So it's not like you're allowing home ownership for all of these individuals. You're just preventing these individuals from renting those homes and living in those neighborhoods, maybe those better school districts. It actually is pro-gentrification. Well, it doesn't allow, rentals allow allow lower income individuals to come into an area with better schools. Mm-hmm. And you can't get into that nice area if the only way is to buy into it. So it allows for a more diverse. Now, again, maybe that's why the Trump administration doesn't want to do it. But if it allows for more diverse communities, allows for more mobility, mm-hmm. allows for a freer market, for a better market, more liquid market, by having a large buyer, just like any assets. I mean, the largest institutions in the world are buying homes or buying mortgages. They're buying mortgage-backed securities, just like the FHA, the Fannie and Freddie they issue, and then they also purchase themselves. So this is just a political card that they're playing for the midterms.
I think that's really accurate, and there's enough people out there that will hear this and not investigate it and think that the impact of this will be significant, and the ability for home affordability to become attainable. It's interesting, just the problem that this is trying to solve is single family home affordability. in this article, it discusses, the relatively minuscule percentage of single-family homes that are owned by these large institutional investors that own over 100 homes. It's very small. There may be certain markets where it's a little bit more prolific. They talk about how these institutional investors are outbidding single families from buying homes. Just similar to what you're talking about, and in combination with this CBRE quote or report that the single-family rental inventory had actually declined by 1.7 million units since 2016.
Yeah.
So a declining inventory of single-family home rentals, this will probably be exacerbated or declining farther in the future if this does come into action. You mentioned the rental affordability of single-family homes now skyrocketing just because the supply is coming down. The demand is likely to stay the same, if not increase. And then we're not even talking about what this does to the large-scale rental housing, multifamily communities, and our ability to grow rent and obtain occupancy.
Well, the reality is it's actually probably good for, it's actually beneficial to multifamily if this happens. I don't think this is actually going to happen, but if it did, you'd be reducing rental stock. And so, less supply with the same demand will put upward pressure on rents. And again, the people where affordability means the most too, that impacts, are individuals that are renting. Mm-hmm. It's not the homeowners that have tens of thousands of dollars, if not hundreds of thousands of dollars for a down payment.
Right.
Those aren't the ones that need the most relief. I mean, are there some folks in the middle class that are trying to get that first home purchase to start building wealth 100% on the margins? I hope those people are able to buy their homes, but the most people who have the most affordability issues are renters. And so what you're getting at is it's not really even a problem. We've seen the stock decline.
Right.
And according to this recent piece, over the past few years, companies owning 1,000 or more homes have accounted for only about 1% of all single-family purchases. But in 2024, their purchases appear to have dropped to effectively zero. And then it goes on, purchases by entities that own more than 10 homes have ranged from 2% to 6% in recent years. That means that the 20% or so homes being bought by investors are predominantly being sold to smaller landlords who own 10 or fewer homes. Now, if this was being really the only way to actually make a dent in what they're talking about is essentially to outlaw rental housing, to outlaw single family homes from being rentals, because you'd have to say, homeowner, you sold your home, you were moving, you kept your home, you turned it into a rental to get some additional income, you go to jail. If you own a couple houses because maybe you inherited one, you thought it'd be a good way to generate a little extra income, you go to jail. You can't do that anymore. That is such a building block of wealth in this country and entrepreneurship. Right. And the idea that we're going to erode and attack, again, just a fundamental form of capitalism, which is buying real property. I mean, so much just fundamentally comes down to, private property, real estate, and the fact that the government's going to come in and say, we're going to put a limit of what you can. Again, this is just something that comes, right out of are we talking about Cuba, Venezuela? What country are we living in, and where do these people go to school? It's absolutely insane that it's being proposed by anyone, let alone a Republican administration.
The very last sentence of the article states, renters looking for single-family homes in which to live will have fewer options, and the U.S. home building rate will be pushed down by regulation once again. It feels like maybe, we're totally missing the target. He's trying to solve one problem that potentially doesn't even exist, but perhaps through solving this non-existent problem, he could potentially create more by reducing the number of single-family homes being developed. Just the housing stock getting smaller, rental housing stock getting even smaller. It seems like the cascade of impacts that this could have on, just the housing market is rather maybe unthought.
The unintended consequences.
Yes.
I mean, haven't we learned, government in terms of regulating so much? Not that saying we shouldn't have any regulations. We should have some reasonable regulations, but generally get out of the way. Yeah. And if any acknowledgement, the Biden administration, not a fan of the Biden administration, but go back and read all of their executive memos on housing, which we covered every single one on the Gray Report. they outlined, what we needed to do, and the solutions were not this. The solutions were basically we need to deregulate, loosen up regulations, and zoning restrictions. That's the solution. If you want to get interventionists, give out some carrots, build some more housing. The solution is more supply, not restrictions, not more regulations. So this is just going in the opposite direction. I think you're right. I don't think this is ever going to happen because I think that they've said they're talking about maybe an executive order, but they basically said this would have to be codified by Congress. Once anyone starts actually looking, again, knock on wood, you start looking at any of the economics, any of the math, you go just a half a centimeter deep into the topic, you realize how bad of an idea this is.
Correct.
So I don't think it's necessarily going to go anywhere, but the fact that it's even being suggested is I think dangerous.
Right. Do you remember, I think it might have been last week, 2 weeks ago, there was a tweet from President Trump that just said, basically stay tuned. I'm getting ready to announce, one of the more meaningful, impactful, housing policies or policies that will impact the housing market. He had everybody kind of on their toes, on the edge of their seat, waiting and waiting and waiting. Do you think that was what we just talked about, the ban of institutional investors buying up single-family homes? Or do you think it's the direction in which we're going next, where he has mandated the purchasing of mortgage-backed securities?
That's a great question. Trump is going to be in Davos, I think, next week in Switzerland for the Davos meeting. There's talk that they may announce a housing emergency because we've been talking about them announcing that we're in a housing emergency. And I kind of thought that they had announced it because they've been talking about announcing a housing emergency for so long, which it's a little bit of boy who cries wolf because you can't be hinting at an emergency for months or a year on end. How big of an emergency is it? Which it is, but it can't be that important if you're delaying it so long until you have the ideal time to roll it out. And then when your solutions that you come out with aren't even solutions, they're half baked from the other side of the aisle, from the National Democratic Socialists, maybe got Madani to work on this. I don't know, but it doesn't seem like it came from anyone that has ever been involved in real estate. But I'm
going to slide an anecdotal story in here, just as you mentioned the housing emergency in the United States. My parents are floating the idea of downsizing.
Okay.
So we went out this past weekend, looked at a couple of ranch-style homes with a real estate agent here in Indianapolis, and I'm just, curious. So start poking and prodding. We know this real estate agent super well, so there was no, I wasn't infringing on any relationship barriers. But his general disposition on the housing market, single-family housing market, specifically in Indianapolis, where he, operates his business, there's more homes in the market than there's been in the last 5 years. The time that they're spending on the market is growing, week by week, month by month. And the number of price cuts that are being implemented to offload or get the market sold or get the house sold is growing. And it's interesting, there's an affordability, concern or issue in the American housing market, but it's also interesting. It feels like in the single family housing market, there is somewhat of a price discovery that is happening currently. And if you get on Zillow or Redfin or whatever you use to find your single family homes for sale, relative to 3-4 years ago, the prices are what I would think is a little bit more acceptable. They're still rather high, but they're coming down.
Yeah, well, it was like the rate of the growth is really slowed. And I don't know, and I have to look at Indy. I thought the rate of growth was year over year was slightly positive, not negative, but it seems. But you said it's price discovery. So it's average price sold, but it's the idea of what you think you can get, and those numbers are coming down, being reduced, and they're not getting those reach numbers. But inventory. It sounds like still really low, but increasing.
Correct. He said it's basically if you want to 2 years ago, 3 years ago, you want to go look at a house, you were elbowing people kind of out of the way when the housing market was kind of taking off and ballooning. Maybe that was 3-4 years ago. My timelines could be off. But these days, if you want to go look at a house, and there's certain houses that are more attractive than others, and maybe they're just priced to sell. But he said now it's more likely that you're the only person in that house looking at it, and the offers are way more in favor of the buyer and not the seller. Whereas it seems like 3, 4, maybe 5 years ago they were very it was a seller's market rather than a buyer's market.
Well, I mean, think about how high rates were compared to where they were. I think just recently, I think maybe they're below 6%, but they've been in the mid 6s. Yeah, which is definitely, it's helpful, but still, it's really expensive. You have to think about what the down payment you need to put down to buy the house, and then it's still a big payment. I mean, it's 2 to 3x what it costs to rent.
Right.
Not accounting for furnace, hot water heater need to be replaced, all that fun stuff.
Which kind of come back to the conversation that you mentioned earlier, the idea that the single family home is an asset. I would say it's debatable, in my opinion.
I would agree. I mean, Robert Kiyosaki to Grant Cardone, et cetera. It's view the house as a liability.
Yeah.
I mean, that's the way I look at it. I mean, I own a home. You own your own home, and we do it for other things other than investment.
Typically,
reasons.
Assets should pay you. I feel like I'm just paying my house.
I'm definitely putting money into the house. I'm paying it. It's not the other way around. Maybe one day. But like Alex and I, we put a decent amount of money into our house. Where maybe if we get our money back out of it, which we probably won't, that'd be great.
Right.
Probably not. Well, we're talking about the housing market. We're talking about the Trump administration and policies. It's because it absolutely has been gravitational in its effect of moving the discussion to potentially markets. So the next topic we want to talk about is the announcement for the FHA to go out and buy $200 billion of mortgage-backed securities, MBS, from Fannie and Freddie, with the idea is that the increase of purchases of those bonds will go to reduce the spread that investors and those agencies are charging over the index rate to reduce mortgage rates and increase affordability. This is somewhat controversial because typically this is essentially monetary policy that typically the Federal Reserve pursues. They're the ones that typically will go out and buy, large chunks of bonds. They've done this in the past. They did it after 2008. They bought, I think, over almost $1 trillion worth of MBS back, after the Great Financial Crisis to backstop the market. So this is certainly not that large, but it's unique in that we're not in a crisis, although if they call it a housing emergency, maybe they can describe a crisis, but it's not like we're in the middle of a recession like 2008. Or when they did it back in COVID, I think they bought around $10 billion of MBS to support liquidity for Fannie and Freddie in the market, just because they wanted things to keep moving and percolating. This really seems to go in contrast of the Federal Reserve, because what the Federal Reserve is doing right now is they have been letting their MBS that are maturing, they're letting them just roll off and they're not repurchasing. In the past, if they had the mandate to maintain their balances and reserves of MBS, they would have an MBS that was maturing, they'd get that money back, they'd go out and buy the same thing. So they would just keep cycling it. Instead of doing that, they've been letting them just roll off by about $15 billion every single month.
Yeah.
So Scott Bessent, Treasury, through the Trump administration, said, hey, that rolling off, that could put pressure on spreads, and maybe is even widening spreads marginally, although it's probably pretty marginal. So let's basically counteract that spread widening by doing the opposite of what the Fed's doing. Let's start purchasing those bonds ourselves, because the agencies can. We can direct them to do that, and the agencies have liquidity. My research, they've got about $100 billion of liquidity that they can leverage to buy this $200 billion of residential MBS. One of my first questions was, does this include multifamily MBS? Because Fannie and Freddie, they don't just securitize residential mortgages. They also securitize multifamily mortgages as well. I have not been able to find any clarity other than speculation that's like, well, but they're definitely talking about single family homes, and the goal would be to make single-family homes mortgages more affordable, but also the goal is to make housing more affordable. And so you can make the argument that, multifamily would be just as applicable to reduce those spreads on multifamily as well. But it's a big paradigm shift, and you can make an argument whether it's the right move for the housing industry. You could say that's just more intervention in the economy. But to me, we have to, macro investors are really going to have to think about what is this new dynamic between essentially the executive branch playing monetary policy as well as the Federal Reserve playing monetary policy. Because usually the way it's been is typically you got Federal Reserve over here, setting interest rates, buying bonds, monetary policy. Then you have the actual government, typically Congress, that's doing fiscal policy. We're spending money. A little bit of the executive branch too, but Congress is the one that's supposed to be doing it. We're going to spend the money. We can stimulate the economy through, what we spend the money, what we don't spend money, and then you buy up the bonds. But so now this trading of roles is an interesting dynamic that, again, we'll see if this is one-off event, or is this going to be a tool that this administration uses and future administrations potentially use to affect monetary policy when the Federal Reserve isn't currently aligning with the goals of the administration.
It's interesting. The goal here seems to be reducing the overall spread of the mortgage. The mechanics of the liquidity at the local regional banks, in order to get those loans off their books, provide them the liquidity to then turn around and increase their lending to originate new loans.
Yep.
What is the mechanics here? And maybe I'm just misunderstanding on how this policy and how these efforts are going to actually reduce the spread, in these mortgages. Because I understand that it's not going to directly impact the 10-year, the 5-year, but the banks kind of have the say on the spread. And so can you maybe briefly just describe the mechanics of how that spread is impacted by buying back some of these?
Think about it, when you're thinking about a bond, and it goes back to cap rates, but yields go down, prices can go up. Essentially, is that mechanic, and so by reducing the spreads, you're also essentially reducing the risk, because you also have risk equals return. You have a lower spread. You'd only put on investment that has slightly lower risk. That's why a short term floating rate loan that may be a little bit more risky is typically going to be charged a higher spread. Okay. And so if there's more buyers, there's essentially a perception, okay, it's a little bit less risk. We'll bring that spread in a little bit. Okay. That's the concept there.
It's interesting. I just service level would have never really drawn that conclusion of that impact, and like you said, it may be marginal, insufficient, it may be negligible.
All of the estimates that I've read and the analysis that I've done is the potential impact could be anywhere between 10 and 20 basis points, maybe 25 basis points. So we're talking about maybe 0.25%, which too, if you're absolutely on the fence, it might help a few people. Could
move the needle. Just the biggest impact for me on this mandate is just providing the banks the liquidity to go out and originate new debt.
Yeah.
I think that sounds interesting to me as trying to get other single families to go out and buy homes and purchase new real estate. If banks have more money to lend, are they willing to be a little bit?
But that's not necessarily. They have money to lend.
Right.
I mean, the agencies are there. It's not like that they're running out of liquidity. The issue isn't necessarily we absolutely need more liquidity. They're really trying to just put their thumb on the scale of, well, no, let's keep spreads down. We don't agree what the Federal Reserve is doing by unwinding their balance sheet. So we want to basically we just want to offset it in some way, and whatever we can to keep spreads in marginally. I think someone probably they probably had a big board on what are all the things that we can do and what we can do. Maybe it's some of the things we don't want to do.
Right.
There's clearly a lot of things that they could do that they aren't doing or don't want to do. And they're like, well, what's the easiest? And they're like, well, we could say we're going to ban, buying single family homes from institutions. And well, we could go buy bonds. Fannie and Freddie. We're talking about privatizing them. They're viewing them as what can we do with these entities? Freddie Mac's got a new CEO. There's been a lot of stagnation at the agencies. And I think they're looking at, what are we going to do with these things? They're pretty important, potentially highly, valuable government-sponsored, entities that have a duopoly in the residential mortgage market and multifamily market. I think there's a lot of argument of there's an argument of what their role really is, but I think it's worth having the debate, and I think it's good that it is in the national spotlight to have these conversations. I don't think we ever really get into enough of the nuance of why do we have Fannie and Freddie? What do they do? Why do we have two of them? I mean, Freddie was created because they thought they created Fannie and they were like, oh, we can't have one, we need another one because there's a monopoly. We need to have at least a little competition, so we're going to create Freddie. I mean, it's kind of one problem after the other. I mean, providing liquidity to the housing market as a backstop for the American economy, I get it. But we're not in. It's not the 30s anymore. We've kind of evolved, and there's a lot of pretty large banking institutions that would be happy to securitize.
Right. Yeah. Correct.
Residential mortgages.
Seems like there's a lot going on. Uncertain, less of maybe he's trying to rifle shot this, but maybe shaky hands. It seems like he's just maybe a little bit.
They're going after they came to the conclusion that the Democrats were going to run on affordability. They're going to say, I hear whatever you're saying. Why is my healthcare so expensive? Why is my education so expensive? And why is housing so expensive? And those three things, healthcare and housing especially, and food, comes back to inflation, which is what the Trump administration, rallied against Joe Biden for. And so it's like, hey, what are you going to do on housing? They want to have their list to go into the midterms and saying, look what we did on housing.
Right. Here's the main topics, main issues. Here's what we've done.
And they want to say basically they were better on housing than the Democrats said that they were going to be. They did things that the Democrats didn't even say that they would even contemplate, because the Democrats were worried about being called socialists. And so basically the Trump administration is like, hey, we can do socialist policies because we're not worried about being called socialists, because everyone will think it's fine because we're not Democrats. But they're straight up, pretty far left policies.
Seems like every time we turn around, it's tough to keep up. There's just a lot of things happening, whether it's in the multifamily space or if it's just coming out of the executive branch.
Well, I feel like we talk about politics more than I would like to talk about, but it does drive. It's powerful, and it's specifically driving our industry. And what I think is fascinating about multifamily, housing really, but housing impacts so much of the economy, and the lens that it gives us into the direction of the economy, inflation, employment, GDP. Housing is such a large industry and touches such a large swath of the economy that for its size is underappreciated and not focused on, because it seems kind of boring. It's where people live, it's houses, it's apartments, it's construction. But there's a reason why we talked about it. This election is going to be driven maybe by the cost of housing. And so it's important for us to understand why housing is expensive. If that's the issue, instead of just complaining about it and throwing darts at the board, let's talk about why. Maybe the causes of how we got here and some meaningful solutions, rather than just Blackstone bad, ban the Blackstone guy and they're evil. Yeah. Because that's usually as sophisticated as the conversation typically gets. Right. Or they say BlackRock, and and they don't know one knows the difference.
They don't know the difference. Yeah, it'll be interesting just to see and track these stories, these announcements, the inaction or action that follows, and then, like you mentioned earlier, the unintended consequences that may stem from them.
Absolutely. All right, we've got a report. We talk about most of the multifamily reports that come out. Yardies we cover every single month. And we've got a December 2025 report. The Yardi team always does a good job, led by Paul Fiorella, friend of the Gray Report. And just to read the first two bullet points, to paraphrase, 2025 ended the year on a down note. For multifamily, as a weak late year performance wiped out all of the gains from earlier in the year, the U.S. The average U.S. advertised rent fell $5 to $1,737 in December, with year-over-year growth dropping 20 basis points to 0.0%. The next bullet point is what I found the most interesting. Years without growth are rare. Years without growth are rare. The last one with no average national advertised rent recorded was the 2020 pandemic year. Before that, the last one without a national rent increase was the recovery from the global financial crisis in 2010. Then they say we expect modest increases in 2026. So, I mean, the Gray Report was one of the first outlets to really report on some of the slow rent growth that we started seeing kind of like halfway through last year. We called it out early and said, hey guys, this is not normal seasonality. Basically in May, we were like, what's going on? June, we're like, what's going on? We called it pretty early. And we saw slow growth turning to negative growth sooner than ever. It was a situation of boiling frogs. It just, when it happens slowly, you don't realize kind of what's happening around you. But we just experienced one of the slowest years of rent growth since the great financial crisis. Multifamily was in a troubled spot relative to valuations, interest rates already. Fortunately, in the Midwest, we don't have all of those problems with valuations or rent growth, although rent growth certainly slowed in the Midwest, although just maybe didn't go negative as much. But again, we talk about this a lot, but if you're in Austin, you're in Denver, you're in Phoenix, you're in Charlotte, you're in one of these markets that cap rates got so low, prices got so high, people bought it at a peak, assuming rent growth, 10% rent growth for the next 5 years, and then it went to zero. Prices are down. You're underwater. 2025 was a tough year for multifamily. I guess the question is, was it at the bottom? What do you think?
It feels like maybe the front half of 26 and the back half of 25 could potentially be the bottom. I don't want to say that year 2025 was the bottom. We're still seeing some negative trending rent growth kind of across the nation. I think region specific, but it does impact the overall national average. I was reading a report earlier this morning that involved the growth of concession usage across some of the major metros in the United States. I'm just interested to see how long these concessions can last as the new supply gets absorbed. I think these concessions are really going to indicate, maybe be a good indicator of when we are nearing or at the bottom, as those concessions really do kind of pull back or start to burn off. I think the positive thing for investors in Gray Capital is, we talked about it when we did our webinar for our Midwest multifamily forecast. This slow growth equals better entry points for acquisitions. And so there's a positive lens to be taken here. Then also, if you are an existing investor or have private placements in commercial real estate, but specifically multifamily, just being patient and allowing this cycle to kind of come to fruition. If you're looking for an exit or a recycling of your capital, there's still, I would say, years to be patient. But in the kind of arena of acquisitions, I think if you're not interested or looking in buying right now, you should be.
Yeah, because I think in this environment, when it's easy to get down on the now and last year, you forget that pretty much everything's a cycle, and we're at a certain point in the cycle. And remember how you felt on the other side of the cycle, a couple of years ago, and 100%. Again, 2025, 2010. I mean, going back to when it was one of the last years that we had basically no rent growth, it was 2010. It would been one of the most incredible times to buy real estate. And someone would have said, hey, rents are negative this year. How am I going to buy anything? I don't want to buy multifamily. There's no rent growth in multifamily right now. Yeah. That's the best time to buy. It's not when you buy when the rent growth is already happening. It's usually too late.
Right, it's too late.
It's too late.
The bullet point that you shared regarding the years without growth, dating back to the financial crisis in 2010, that last sentence is, we expect modest increases in 2026.
Yeah.
Would love to have that conversation. I do think a lot of the growth is on the back end of 26. I'm not sure it's going to get kickstarted in Q1 or Q2. That's why I mentioned the back half of 25 and the front half of 26 potentially being that trough, just because there is still negative trending rent growth and the use of those concessions across, what is now, we're in the month of January. And so
we're going to start seeing soon, though. I mean, one thing that the market has changed seasonally is that the cycle has, at least in the last couple of years, it started earlier, started more in March than April and May. And so I'm, in February, we're going to start hearing potentially just what the indication of demand is, because people are looking for, a March lease or an April lease. Mm-hmm. They might start looking in February. Or last year, that's how it was. I remember in February, it was like, we've got all this interest in March, And it turned out that March was a huge month. Mm-hmm. I'm just curious, because there have been a lot of expirations that have pushed into March. If March is as big of a month as it was last year, I kind of anticipate it to be. But we should have some indication, again, not the full story, but I'm very curious to see how March ends up being in terms of leasing velocity, how many leases we post this year in March versus last year in March. But then can we sustain it? Because last year we had a decent March and April, but then we lost all the wind that got taken out of our sails. And by May, we had kind of peaked, and then it was kind of all over by June and July, which typically May, June are some of the strongest months, and then it kind of can peak either sometime between June and July, kind of depending on the year and the specific market itself. But I tend to agree. I think that I'm much more opportunistic about the second half of the year than I am the front half of the year. All market dependent, though. To how much is being delivered and what's going on the ground in that particular market and submarket.
I think with the slow growth, better entry points, the expectation is that transaction volumes will potentially uptick in 26 relative to 25.
Potentially, yeah.
You're getting ready to go out to Las Vegas for the NMHC National Multifamily Conference. I've never been. It's supposed to be a big deal, but you have kind of floated the idea out there that it's attended by owner-operators, property management, and brokers, specifically mentioning that a lot of these brokers will begin to float their first few deals of 26 while they're there. I'm excited to see what you bring back. I think we're doing next week's podcast directly from Las Vegas to give me an update on what's happening at NMHC, but curious as to what your thoughts are on transaction volumes in 2026 based off some of this suppressed or negative growth.
I think we're going to see volumes increase off of 2025, primarily because there's a lot of dry powder that needs to be deployed. I think there is more clarity now than there was last year. I mean, think about last year. I mean, we had tariff uncertainty a lot. We had tax bill uncertainty. The tax bill got passed. Tariffs, I think we're going to have clarity on that kind of this week, whether the Supreme Court decides to kick out the current tariffs and what the new tariff regime is going to be. But I think that there's going to be more, there will be more clarity on that. And so a lot of that risk, geopolitical uncertainty doesn't really seem like as crazy as things are. Like people seem to be kind of brushing it off, and even things like getting into monetary policy, $200 billion of MBS, the market's kind of shrugging that off. People are kind of becoming numb to a lot of the volatility, which I think allows people to kind of get back to business. There's a lot of folks that are looking around. They're seeing the unaffordability of single-family homes, the supply coming down, and looking at where we are in the cycle. And real estate is starting to look really attractive. Real assets typically are, a hedge against, inflation. I think it's debatable of how well they've done over in any given year. I think if you look over the average, they've done, exceptionally well. This year, obviously, with rents growing at 0% and inflation at 3%, obviously that's a pretty big miss and didn't really help you out there. But it's where do you go? I think office is still out of favor, although there's still going to be some opportunistic folks going into office. The equity markets, while they've been doing really well, some folks need to kind of rebalance. Whether they're targeting 15, 30%, kind of like alts, real estate. If you had 20, 30%, public equities growth the last couple of years, all of a sudden you're going to probably need to pick up some more alts. The big driver, though, is if people can actually exit out of their existing deals, these older vintages, whether it was pre-2020 or through any time in 2020, these deals that maybe were purchased at the peak or they were purchased and people have just wanted to wait to get into a more opportunistic time to sell these assets, kind of waiting to see how patient their patient capital is. And so once that capital starts to be recycled, I think we're going to see things pick up relatively quickly. Obviously, something could potentially go wrong in the middle of all of that. You could have like a forced sale and everyone has to sell at the same time, and that's not good. There's nothing to indicate that that's going to happen. And so just a kind of a rolling out of these assets to unlock the market, to unfreeze. It easily could be in 2026. Let's see how the first couple months and the first 2 quarters go. If we've got some stability and we don't think like the world's falling apart too quickly, I think we could see some real increased volumes, and that's going to lead to some, at least I could see some short-term cap rate compression just because I could see a lot of capital coming off the sidelines relatively quickly.
Right. That could be quite exciting. Last question for you, and then we can wrap it up for the day if that feels right. I think it was the apartment list put out a report. We're not talking about it specifically today, but it's included in the Yardi Matrix. Is vacancy rates continue to kind of tick up.
Yeah.
And I'm just curious as to what you think in regards to overall concessions, vacancy rate, negative rent growth. You asked me earlier if it's the trough. I think with all of these kind of KPIs trending in what I would say is maybe not a most favorable direction, what does the occupancy rate or the vacancy rate, increasing? What does that tell you about where we are kind of in the cycle?
It's a good question because demand was really strong. It's been coming down, but still pretty healthy relative to supply. We had seen vacancy kind of peak out, so vacancy had been an all-time kind of like a decade high, but it's really stabilized and started to come in, which I think is representative of a shift from buying to renting. And so we've built more apartments than we've built in 45 years, but those are mostly being absorbed. There's a lot of competition. There's so much inventory that obviously you're going to see vacancy go up over a shorter period of time, but the fact that it's kind of stalled out, it's come in a little bit, shows that there is really robust demand. We're going to need some time to absorb all this slack because there's just a lot of slack in the system. We've got a lot of new, great looking, attractive properties that need to lease up. And so they're giving away the farm to get people in those units. And, I think it was in the Yardi report, they're talking, there are brand new fancy properties with pickleball courts and resort style pools that are they're giving you a lot of money. They're basically giving you free rent. And so if you're in a B-class community or even like an A-class community that was built 10 years ago and you don't have a pickleball court, well, you can go get a pickleball court at a discount. And so there's just a lot of competition, but that is going to over time recede and we're going to normalize the market a little bit. But it's just, so much during COVID, 2020, 2021, halfway to 2022, time and economic activity was compressed. Almost a decade of action was compressed into about a year and a half. So we had this compression effect. Now we have this refractory effect. And, as time was dilated and now it's being stretched out. So, patience is an absolute virtue right now. Way too much happened over way too quick of a time during those few years. And now it's going to take the inverse.
Right.
It's going to just take that much longer for all of this to unwind. And as frustrating as that all is, because we all want things to happen right away. But that is exactly why when we do these multifamily deals, we don't buy them to sell them in a year or 2 years, because I don't know what's going to happen in a year or 2 years. I can't tell you if we're going to make money in a year or 2 years off multifamily property. I can think we will, but there's a lot of things that are outside of my control. So in order for us to maximize the chance for us to make money, a good amount of money by investing into real estate and multifamily real estate, is by giving ourselves time, allowing the assets to appreciate, to use debt to our advantage, and the fact that rents do rise faster than inflation to build wealth over time. We're in a very positive, I guess, over the period, we're going to be a very positive supply-demand environment.
Yeah.
Housing is an absolute demand. We're still in a shortage of housing, so it's a great place to be. It's just you have to be patient in order to be able to pick your exit.
Right.
So that's what we're going to do.
Patience is a key component of real asset investing.
Yeah. Well, you have to just acknowledge you just don't know. You just can't
Right.
time things. Just don't think that you
And
can.
if you do try to time it, what the percentage chance of you timing it appropriately is beyond me, but it seems unlikely that your timing would be hyper advantageous as
luck.
opposed to just being patient and
Yeah.
using the market data and your cues to pick the time. That is right.
Exactly. Good point, Griffin. All right. Well, thanks for watching this episode of the Gray Report. Let us know if you like that the little the jargon bin. We talked about cap rates. If you like those explanations, or if we just were even more confusing, leave a comment below and subscribe to the Gray Capital YouTube channel. Thanks, Griffin.
Yeah, absolutely.
Have a
See you
good
next
one.
week.
See you next week.